Did you know today was Black Monday 1929? Certainly didn't anticipate the markets to give us as bad of a downside day as what it gave us. We were positioned for it, but at the same time, there were more than a few indicators that were suggesting that we wouldn't see that degree of a drop off today. But that's okay. We had a lot of bonds, we had lots of cash. Raised more cash throughout the day simply because the bonds ended up getting to a level where it appeared they wanted to reverse and start heading down. So we captured what remaining profit we had in them for the day just to stabilize the value of those particular assets. There are tons of things that I would love to buy in equity space right now at current prices. The problem that we run into, of course, is that the volatility regime is in the wrong spot. And so what I mean by that simply, and you've heard me say it over and over and over again, is that when volatility gets to a certain level, typically if VIX trends above 31, it becomes really problematic because you can get these hard, swift down days like what we experienced today. And if you're not positioned correctly, it can really whack you. So you had the S&P 500 down over 3.5% today. I think on balance, the majority of our risk-based portfolios, the different risk measures that we use, the vast majority of portfolios might have been off maybe 0.25%. But that's because we're risk managing the cycle for where we currently sit within the volatility regime. So I'm going to share a couple charts with you just to give you some viewpoints and perspective, and then we'll be done. So we still believe that we're in quad 3. Before I show you the charts, we still believe that even today was very much of a quad 4 day with the dollar up, with almost every asset class down, including oil, showing a deflationary subset to its price action. All that being said is that the market still seems to be sniffing out for Q1 of this next year. And so, coming into an election cycle like what we're doing right now, not a lot of differences than kind of what we saw in 2016 so far in terms of market action. So probably be a little bit volatile over the next week or so, if I had to guess. Tomorrow's probably wouldn't surprise me if we saw an up day. Which will be fine. We'll make some adjustments and decisions based on some of the equity positions that we've got, which primarily is focused on the things that work in quad 3, and it's not a lot. We're sitting right now on about 80% cash, so we have lots of opportunities to deploy once volatility settles down. And so that's what I want to share with you first, is just kind of give you some pinpoints on what volatility looks like. So this is a picture of the S&P 500, but more importantly, what I want to show you first is the interest rate cycle. We had this big bump up in interest rates, and then the math, so we do the math every single day that gives us an idea of what the potential top side and downside movement would be for interest rates. And we had been doing this math, and that kind of is what this blue line represents. You can see interest rates popped all the way up here, broke up above that level for a day, and then fell apart. And so we saw a pretty big trend reversal, which helped our bond prices substantially, and certainly helped to stabilize portfolios over the last couple of days of equity market selling. But today, interestingly, intraday, interest rates reversed. So you usually don't see that, where the equity market's selling off really, really, really hard, and bond yields switch. So the one thing that markets might be doing is sniffing out a quad 2 in Q1. Why do I say that? Because the 10-year Treasury, if we were anticipating a quad 3 for into Q1, or a quad 4 even for the remainder of Q4, we would not have seen interest rates reverse and go up today. I don't believe. I think we would have seen interest rates continue to collapse, and that didn't happen. So I made the decision to unwind our current bond positions at the profit that we had, and a couple of them within break-even range. So again, just to be more protective in nature. We saw some of the same stuff in February and March when all of a sudden investment-grade credit started to break apart, and then Treasury started to break apart. And that happens when you get into a deep selling cycle, because a lot of the levered long hedge funds, those that are levered up in their positions, they get to a point where if their leverage gets called away on them, they don't sell what they want to. They sell what they can. So they start unwinding the most liquid of assets that they've got. And in some cases, if they are holding on to treasuries, they are very liquid, and they can, in many instances, get rid of them very, very quickly. So back to the chart. So at any rate, we went ahead and unwound the bond positions with this movement in interest rates. It's hard to say what happens, but it would not surprise me to see interest rates spike back up into this range, which would be about 0.83, 0.84% on the 10-year Treasury, which would give us an opportunity to buy them back at a much, much better price, and then we could see interest rates start to move away, again, depending on what happens within the context of the economic sine curve. If we look at VIX, you can see it just exploded today. It was up about 21%. It took out the September high. That's very important because if we think about price, so let's take a look at the S&P 500 real quick. Here's the September 2nd high in the S&P 500. Here is a lower high in the S&P 500 that was recently made. And then if we compare that to how VIX moved up as the market moved down, we can see the market moved down real hard at the beginning of September, mainly through September as we remember, and then rebounded to this lower high. Well, if we compare that to what volatility did, here's volatility that as the market pulled back and volatility started to eke out to the market, it stabilized. But now volatility's made a new high compared to what we saw in September. It hasn't taken out the June high yet. So remember, June was a real bad time for the market back in here. And then it ramped back up into September and it got hit. And now we've got this lower high. And so the question becomes, if we start to compare what volatility is doing with the price action of the market, these two data points, these 2 points right here of a higher high in the volatility level comparative to a lower high in the index itself has got me a little bit concerned. So I mentioned there's a number of things that would be awesome to be able to buy in equity space. The reason I'm not is because volatility is in a bucket, or a regime as we call it, that becomes uninvestable. And it becomes uninvestable because you can get these really hard, swift down days that can go against you really, really fast. And so we don't want to do that. We want to maintain discipline, follow the math, make sure that we're risk managing each of these positions appropriately through in the cycle that we're dealing with. And so, you still have this bit of a tug of war that I've talked about before with the market right now in this exceedingly short-term period, kind of tugging between quad 3, quad 4, stagflation, deflation, and then sniffing out what might become quad 2 in Q1 of next year. And so that being the case, we also saw some things happening in gold that became very oversold, and it appears we might see a bit of a bounce there. So we took a very, very, very small position in some gold again, and we'll work that through as the days progress. And we're watching very carefully what's happening with the interest rate cycle, and then also specifically with regards to the yield curve. So one of the positions that does well is the yield curve expands, and a yield curve would expand if the market anticipates a greater degree of economic activity. And a greater degree of economic activity, of course, is a sniff out towards that quad 2 growth with inflation kind of an environment. So what I'm looking for is the volatility measurement to settle down. I want to see if VIX can get back down into a more normal mathematical range. So in other words, is this particular episode of volatility what we would call non-trending? In other words, does it just stop here, completely collapse, and then get back into a chop, as we've called it before? Or are we in for something a little bit more problematic, like what we saw back in February and March, where we had this explosion of volatility? And here's what's interesting. We had this explosion of volatility at the end of February, and it's still at this level of explosion considerably below where we are today. This explosion that occurred back at the end of February took volatility up to 24, 25. We're currently touching 40. And this particular time frame, we didn't see 40 on volatility, 40 on VIX until March 5th. it's important to understand that only because if we kind of draw that backward and look and see where the market was on March the 5th, you can see it was here. Here's where volatility started to explode. Here's where it was on March the 5th, which is an additional roughly 10% below this first explosion of volatility. So this is something that we would call episodic and trending, and it's trending in the wrong direction, and then it settled down. All right, so that's exactly what we want to see. Is this going to be a quick episode of volatility and have it pull back in, or is it going to turn into something different? And the answer to that right now is I'm not 100% sure. We have to do the math tomorrow morning based on price, volume, and volatility. We have to see as to whether or not volatility measurements give us a higher high. So when we do the calculus of price, volume, volatility, it gives us a high-end number and a low-end number. I compare that high-end number to what the price currently is doing, and if the price, volume, volatility calculation is higher than the most recent high on price, well then that's a problem. That's the sort of thing that suggests to me we could see a higher degree of volatility coming in over the next few days, which would cause a continued hit on index price. I'm not convinced that that's going to happen, but the just point is it's a possibility. So we got to just follow the math one day at a time. Bunch of commodity elements are in a position of being able to buy, but again, I got to get that volatility quotient for the commodity sector back down. You look at some of the commodity volatility pieces real quick. OVX, which is the oil volatility, this is way out of bounds. 59 on oil volatility is terrible. And so even though oil is a quad 3 own, a quad 3 long, I would not want to be buying oil here until I can see volatility break down below maybe 46, 47. Gold volatility looks much better. You can see it's still below 25, 24, 25. This is a good area. And so that's one of the reasons why I started a small position in gold. Gold sold off today. Volatility did not break out like what equity volatility looks like it did. Bond volatility came down some, which, as you know, is the MOVE index, but it didn't get below 56. So since it didn't get below 56, that just helped confirm my decision that it was a good spot to unwind the remaining bond positions that we had before they got out of control too. And I'm not suggesting that they will, but point being is that when you have this much volatility leaking into almost every single asset class, the best and safest place to position yourself is within those areas that are trading in the world today that are quad 1, quad 2, and also cash. So we've got piles of cash waiting for a better opportunity to deploy, and at the same time we also have some very small positions in things like, as I mentioned, gold, and we'll continue to work on that as gold price allows. We continue to have positions in places like Taiwan, China, Finland, Norway. Taiwan is very heavily after hours right now. China is acting much, much different than most other markets. Finland appears to be doing just fine as well in terms of their economic cycle. So one day at a time, like everything. So if you have any questions, let me know. As you know, I'm always happy to hear from you. I'm always happy to answer whatever questions might be on your mind. Direct line 608-354-1977, and my email, chris@careformywealth.com. I think things are a lot more optimistic than what several people might think right now. As I said, that's what you get sometimes when you're transitioning between economic phase cycles in a market attempting to sniff out what the next quarter might in fact look like. So we're going to keep a sharp eye on that and certainly deploy capital in spots in a judicious manner consistent with what volatility is telling us. If the volatility breaks back down, then we'll put on the quad 3 longs and prepare ourselves for that next cycled quad 2, which is much heavier in the equity focus, much heavier in opportunities to grow the portfolio versus be protective like what we've been. But we've been protective because of days like this, and when volatility stays chronically elevated, well, this is the reason why we do that. So at any rate, again, any questions at all, please let me know. I know some of these things can be a little bit confusing at times, and want to help explain them as best as I can. Thanks again for the opportunity to work for you. Certainly appreciate it. Have an amazing evening, and God bless.